Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And I can't believe we're at the end of another quarter, and we have the privilege of bringing on Nassau's Chief Investment Officer, Mr. David Czerniecki. David, thank you so much for coming back.
I'm happy to be here, Paul. I too am shocked that we've been through another quarter.
Well, it's interesting that, the questions we've been asking, they kind of stay at the top, have been stayed at the top of the list, but they've kind of changed a little bit each time. Now, I guess, first question is the interest rates. The Fed telegraphed a couple of weeks ago that they were going to cut interest rates. They keep saying they're going to. A lot of people are excited in the market, but what does that mean for the insurance industry? Should I be rushing out to talk to my clients and tell them to buy MYGAs? How should I make sense of this?
Sure. So a couple things, Paul. Yes, the Fed is I think almost gone beyond telegraphing, right? At this point, if you look at the various forecasts and what the market is pricing in, it's interesting. There's this big talk of, everyone expects the Fed to cut interest rates in September at this upcoming meeting. There's a debate as to whether it will be 25 and 50 basis points. As you know, we had jobs report today. So it's kind of in between. And so, but what the market keeps doing is between now and the end of the year, it's pricing in about a week. And so depending on the mood in any given week or day, some of that's maybe more front loaded, so it's 50 and then 225. On a different day when things are, the economy's looking maybe a little bit better, or the numbers are looking a little bit better. They're pricing in a quarter now and 50 in December. But everybody's kind of coalescing. What we've seen is a couple things happening with the yield curve. One is you're starting to normalize a little bit. If you remember, in the past, we've spoken about the inverted yield curve, where short rates were significantly above long rates. You tend to look at the 2 versus the 10-year in that. And they're pretty much in line now. So you'd say it's more of a flat yield curve, but that's the first time in a while it's been flat. So we expect that the Fed will cut. It'll probably be more than one cut unless something strange happens. Cycles tend to be cycles, and so there's probably going to be some cutting on for some period of time. What will it do to the intermediate and longer part of the curve? Because that's where you're pricing product off of. That's what your investors, your clients are thinking about. They're not thinking about what am I, they can put the money in the bank or go find a high, interest bearing account to capture still this little bit of higher front end of the curve. But eventually that, if the Fed keeps cutting, that's going to go away. And so the question, of course, is should I now and lock some of this in? We're not in the business of giving advice on this, by the way. But what I will tell you is that, the expectation is that, rates are coming down. And, when I think about what we're doing in our own investment portfolio, we're trying to get a little bit more duration. In other words, we're buying a little bit more of the intermediate and long term to try to lock in some of those rates. So I can't tell you what to do with your MYGAs, but I can tell you what we're doing in the portfolio. And, and we don't expect a bloodletting here in terms of rates, but I think most of the risk in rates, in the actual level of interest rates, is to the downside, not to the upside. Yes, there's some chance inflation proves more stubborn and the Fed doesn't lower rates as much or as many times as expected. In which case, mid-tier, middle of the curve and longer rates may come up a little bit. But in general, what is everyone worried about? Worried about the economy getting softer, not worried about it getting stronger. They're worried about the jobs market, and we're seeing a little bit of softening there. So it doesn't seem like we're staring down, as the economists like to say, the risks are to the downside here economically. And so therefore, it feels a bit more like rates are more likely to come down, go up.
Yeah, it always feels like this industry can handle macroeconomic changes pretty well. To your point, the Fed rates are short term. What happens long term? What we don't handle very well is fast changes one way or the other. So, I mean, if we assume rates are going down, faster rate declines better for the market, for the insurance, the value in the insurance products, or is it better if we're better off if it's slower cutting of rates?
I think, from a client perspective, you'd rather see it come down more slowly, right? Because I'm on the fence. I'm not sure what to do. Should I wait one more month? And if it's, you kind of see this chipping away, drip, 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 you say to yourself, okay, look, this is the direction of travel here. How long am I going to, when things are volatile, right? And these big swings are a bit of a challenge. And as we've spoken about before, in the rates markets, we have seen some very, very, very significant swings over the last several years, as we have in the equity markets as well. We think that, I think investors, look, nobody likes uncertainty. Nobody likes surprises, right? You can, name an industry, or a profession, that's a good thing. And so, I think we'd rather see a steady march, than big swings. And there was a lot of noise a few weeks ago, but people were pounding the table for the Fed to make an emergency cut. The Fed was not going to make an emergency. Nothing was that down.
Right. Right. Now, okay, I have to talk about AI. We talked about it every time.
Right.
I think you had to be under a rock to not hear about the drop in stock prices.
Yes.
My portfolio was overweighted, has been. I'm still very bullish on it. But I guess, what's your perspective on this? Is this a bubble about to burst, or do you think it's more a rotation and a lot of companies sort of locking in gains they made on stocks like Nvidia and Google and Microsoft, some of the larger tech firms?
Yeah, I've not read much, and actually, Paul, let me give you my standard caveat. 95% of our portfolio is in fixed income. That which isn't in fixed income is in sort of private market stuff. So I don't spend a lot of professional time in this space. Maybe a little bit of personal, a little bit out of professional. So this is sort of a little bit of a worm's eye view of the whole thing. But what I will say is that I've not seen a lot published and printed about confit taking. Yes, people trying to time the market, and yes, there's been a lot of noise about Buffett taking some chips off the table with Apple. But in general, I think it's been more about a very, very, quick, rapid run up and people taking a pause, a little bit of what we call a correction, right? And that's when the market doesn't, plummet, but it goes down. Don't forget, we've given back, but we haven't gone back through where we started, right? That would be a different story. And, I think most people are aware of the themes, right? There's this relatively new technology out there that seems to show a lot of promise. We had something like that, back in Edison's day, we called the light bulb, right? And, and then we had, Netscape and the .com thing, right? And so everybody gets excited, right? There's a bit of a rush in, you don't want to miss them, right? And what we're seeing is that, as with a lot of these types of technologies, it's going to take some time for it to manifest itself into sort of a new economic paradigm or regime, or just, improvement. Maybe it's not even a new, maybe it's just an improvement. I think a lot of people think it's, but either way, right? And I've seen research that suggests that it is a bit overdone, not only from a stock price perspective, but from the expectations of, the productivity boost and things like that. But no one's saying, I'm not reading anything that says it's not going to happen. What I'm reading is stuff where people are arguing about how long it's going to take.
Yeah. Well, I'm certainly in that camp. Yeah, switching gears a little bit. We cut the sound, but we had a presidential helicopter coming over. Good. Too bad that wasn't the segue into the third topic, which is presidential elections. So, David, we have choice A talking about tariffs, dictating, artificially depressing interest rates. We have price controls, on another side. Generally, presidential elections haven't, and we've talked about this, haven't had a lot of impact on macro factors. I've certainly gotten a lot of, requests from, reporters of the last couple of months to say, what's this going to do for your retirement portfolio? And my answer has been, it's a blip. Long-term savings habits outweigh presidential election. Is this any different? I mean, given the economic policies that are kind of coming up to the surface right now?
Yeah, I mean, look, there's always, some noise around the election itself and then the implementation of, kind of new, new parties and sort of new leadership in government one way or the other. And in this case, no matter what you do, you're going to have leadership, right? But you're right. I mean, generally speaking, the economic impact is a little bit longer term and kind of, the things like GDP and macroeconomic factors tend to weigh out more than the rhetoric that tends to come from the pulpit. Now, having said, somebody could do some. It's not going to come as a big surprise to you that given what I do for a living, I tend to be a free marketer, and so I'm not a particularly big fan of tariffs unless there's an unlevel playing field that needs to be adjusted and protected. And I'm certainly not a big fan of price controls. But we've also seen, at least on the price control side, that some of that rhetoric can't walk back already. But the other thing is, Paul, it has to get through the Congress. These are not something somebody could do. I think we proved in the 70s that price controls don't work so well. But it has to get through the Congress. And even if there's a tilt, and change in leadership in the House or the Senate, and I suspect even if there's a full-on sweep, by one party or the other across, both houses and the Oval Office, you still need a lot of votes because there's still moderates, and so you still need a lot of votes to get something done. And this is the kind of stuff. The tariffs they can do unilaterally. We saw that in the last administration, most of which weren't taken. The concerns, of course, are that you've seen and read a lot about the fact that tariffs can be inflation. So there's some concern that that'd be running counter to the Fed. The on the flip side, say price controls. Actually, I'm not sure how far the president can go on their own with that. I don't think it's that far. But if you did, you're just creating a distortion. It's gonna you're squeezing a balloon, right? It's gonna come out somewhere. But I'm not overly concerned about a big swing here, a little bit more so on the tariff side, because I think we know that's more of a Republican part of the Republican platform, and again, we've seen that movie 4 years ago, so one would expect the former President Trump to make good on some of those promises if he came to office, but there are limits, and there's action and reaction. So, to the extent we put tariffs, we're going to put more tariffs in place, there's going to be knock-on effects, but none of which I think are positives for growth. So I do think it's a little bit concerning, but I do think it's hard to execute big programs here.
Yeah, thanks. Last question for you. Wars, not a happy topic.
No.
First time in 80 years, I think a foreign country is occupying part of Russia, yet the economy keeps marching on.
Mm-hmm.
What's happening? I mean, are we seeing a sort of a rewiring of the global economy?
I think the answer, this is a classic yes and no kind of thing. Sadly, the situation in both, Ukraine and in the Middle East are, the situations there, are both, catastrophic from human toll. Neither are super significant from an economic toll because none of those economies are that big. I mean, Israel's got a pretty decent sized economy, but that economy is still working. Ukraine is obviously, we found ways around the food, to work around the food thing, at least for now. We found ways to work around the gas, the export bans and things like that, at least for now. So from a global GDP perspective, it's a relatively small impact. And I think that's part of the reason you're not seeing, you're still seeing growth on a global basis. Now, having said all that, the other part of your question, are we seeing sort of fundamental changes in sort of world trade? The answer is yes. It doesn't have anything per se to do with the wars. It has to do with sort of this, rise of sort of nationalism, this sort of decoupling of what were decades of globalization and the sort of the fraying of some of, we were just talking about tariffs, right? That's a change in world trade, right? Those kinds of policies. Yes, there have always been some, but not to the extent that we're seeing lately. Not to this extent. The dynamics of the sort of the G7, kind of the leading economic powers are shifting a bit, and you're fighting a bit more of an economic war on sort of West and East than you have been. I mean, China is a very, very large economy. It has grown, very, very significantly over the course of our lifetimes, right? And it is now, it is a major player on the world stage economically, and guess what? We're competing with them. So each of us is trying to win here and there and this and that. And so that's having an effect, and it's having knock-on effects to countries in our respective regions and our play there. So you've seen a significant pullback in world trade. Some of that was driven by COVID, but some of it's economic competition. And that trend seems to be here to stay for a while. So I think you're going to continue to see some impact on global GDP, in global trade, as a result of sort of nations competing economically, which is better than bullets.
Right? Exactly.
Right.
Exactly.
But I think you're seeing that play through. I think it's important as an investor to always be aware of what's going on with China. What's going on with their economy, its economy, and its trade flows and things of that nature, because it's too big to ignore, and they can have an impact. I've said to you before, the old adage, when the U.S. sneezes, the whole world catches a cold. To some extent, that's now true for China too. And so we always, as investors, have to be mindful of what's happening there, because it does impact global flows, global trade, global growth.
All right. Well, David, thanks so much for your time. This was great. And listen, I'll look forward to our next chat 3 months from now. Okay. Thanks. Thank you very much.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.